Welcome to StokTok's deep dive into Qualcomm Inc. Qualcomm is a semiconductor design company that develops mobile processors, wireless connectivity chips, and licensing intellectual property for telecommunications standards. It's the foundational technology inside billions of smartphones and connected devices globally. At the time of recording, the stock is trading at $148.85, positioned near the upper end of its 52-week range. The 52-week high sits at $205.95, while the low is $121.99. The 50-day moving average is $134.31, while the 200-day moving average is at $155.11. The Relative Strength Index, or RSI, a momentum indicator that measures overbought and oversold conditions, is currently at 73.4, suggesting the stock is trading in overbought territory. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Qualcomm generates revenue through two primary channels: designing and licensing advanced mobile and wireless processors, and collecting royalties on standard essential patents in fifth-generation wireless and other telecommunications protocols. The company's moat, its competitive advantage, rests on deep engineering expertise, relationships with every major handset manufacturer, and control over critical patent licenses that are built into global telecommunications standards. This creates both pricing power and switching costs that are difficult for competitors to overcome. The StokTok score currently sits at 47 out of 100, which signals caution to investors. Breaking this down across 5 dimensions, the valuation score is 6 out of 20, financial health scores 13 out of 20, profitability rates 14 out of 20, growth is 6 out of 20, and smart money positioning scores 8 out of 20. This composite score reflects a company in transition, profitable and well-capitalized, but facing questions about near-term growth and valuation after a significant price appreciation. Now, valuation. The question every investor has to answer: are you paying the right price? Qualcomm's trailing 12-month price-to-earnings ratio sits at 28.14 times. That's a premium multiple in absolute terms, though reasonable for a semiconductor company with this quality of earnings. The price-to-earnings growth ratio, or PEG, which compares the PE multiple to expected earnings growth and helps identify whether a stock is overvalued or undervalued relative to its growth rate, is 1.22. A PEG below 1 might suggest the stock is relatively attractive, while above 1 suggests caution. The forward price-to-earnings ratio looking ahead is 12.26 times, which is notably lower than the trailing multiple. That spread suggests the market has room for earnings expansion. The EV to EBITDA multiple, which compares enterprise value to earnings before interest, taxes, depreciation, and amortization, and shows what investors are paying for every dollar of operating cash generation, sits at 10.02 times. From a competitive positioning standpoint, Qualcomm's moat in mobile processor design and patent licensing has historically allowed the company to command premium multiples relative to pure-play foundries like Taiwan Semiconductor Manufacturing Company. In our view, the patent portfolio and design leadership represent durable competitive advantages. The GuruFocus Value, an intrinsic value estimate based on historical earnings and dividends, is $176.19 at the time of recording. The current trading price of $136.20 suggests a margin of safety, a discount to estimated intrinsic value of 22.7%. That discount is noteworthy and warrants investor attention. Wall Street analysts at the time of recording have a consensus mean price target of $150, with targets ranging from $100 on the low end to $200 on the high end. 29 analysts cover the stock, and their median recommendation is a hold. The next earnings report is due April 29, 2026, with the street expecting earnings per share of approximately 2.56, with estimates ranging from 2.50 to 2.66. That earnings report will be a critical catalyst to watch. Market sentiment around Qualcomm, as of the creation of this video, leans bullish with a sentiment score of positive 0.32. The market appears to be digesting mixed signals. Semiconductor sector tailwinds are providing support, but smartphone growth concerns and competitive pressures from Intel and Apple's internal chip development efforts are creating headwinds. In our view, the valuation presents a mixed picture. Not deeply cheap, but not egregiously expensive either, especially if near-term earnings prove resilient. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point health checklist that evaluates profitability, leverage, liquidity, and operating efficiency, scores at 5 out of 9. That's slightly below neutral. It tells us the company is financially sound but showing some operational or balance sheet strain. The Altman Z score, a bankruptcy risk model, sits at 5.51, well above the 3.0 threshold that signals financial distress. In plain language, Qualcomm shows no meaningful bankruptcy risk. On the debt side, the cash-to-debt ratio is 0.80, meaning the company holds 80 cents in cash for every dollar of debt. That's a reasonable position but not fortress-level cash holdings. Interest coverage, the ability of operating earnings to cover interest payments, is 18.19 times, which is very strong. The company generates $18 in operating earnings for every $1 of interest expense, providing substantial cushion. The current ratio, which measures short-term liquidity by dividing current assets by current liabilities, is 2.51. That exceeds the 2.0 threshold typically preferred by conservative investors and indicates the company can cover its near-term obligations with room to spare. Debt-to-equity stands at 0.64, meaning the company carries 64 cents in debt for every $1 of shareholder equity. That's a moderate leverage level, not aggressive, not ultra-conservative. The overall picture is a company with a stable, investment-grade balance sheet. The Piotroski score of 5 suggests management could optimize working capital or accelerate debt paydown, but financial stress is not the concern here. The credit metrics indicate Qualcomm can service its obligations and invest in operations without financial distress. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, the metric that shows how much profit the company generates on every dollar of capital deployed in the business, is 14.06%. In the semiconductor and technology sector, a return on invested capital above 12% is generally considered strong, and Qualcomm's 14% puts it solidly in efficient operator territory. That means management is deploying shareholder and creditor capital productively. Gross margin, the percentage of revenue that remains after subtracting the direct costs of producing chips and supporting operations, is 55.1%. That's a remarkably high gross margin, reflecting the pricing power and operational efficiency that come from Qualcomm's position as a fabless designer. The company does not own manufacturing facilities. It outsources production to specialized foundries, which allows higher margins than integrated producers that own and operate fabs. Operating margin, which includes all operating expenses but excludes financing and tax items, sits at 27.2%. That's an exceptionally wide operating margin. For context, most technology companies operate in the 15 to 25% range, so Qualcomm's 27% demonstrates significant operating leverage and pricing discipline. Net margin, the bottom line profit as a percentage of revenue, is 11.96%. That's solid but lower than the operating margin because Qualcomm carries meaningful debt service costs and has a relatively high tax rate in certain jurisdictions. The spread between operating and net margin tells us that financing costs and taxes are meaningful drags on the bottom line. Free cash flow margin, the percentage of revenue converted to cash that's actually available to shareholders after capital expenditures, is 28.81%. That's exceptional and actually exceeds operating margin, which happens when Qualcomm is collecting cash faster than it's accruing earnings. This is a hallmark of a capital-light business model and suggests management is being disciplined about reinvestment. In our view, Qualcomm's profitability profile is one of its strongest attributes. The combination of 55% gross margin, 27% operating margin, and 28% free cash flow margin demonstrates that this is a business with durable unit economics and pricing power. The data suggests management has built a profitable, cash-generating machine. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3-year period stands at 0.1%. To be blunt, the company has essentially flatlined on the top line over the past 3 years. That's a serious red flag and reflects headwinds from smartphone market saturation, cyclical weakness in wireless handset upgrades, and competitive pressure. However, and this is important, when we extend the look-back window to 5 years, revenue growth comes in at 11% annually. That's a meaningful compound annual rate. What this tells us is that Qualcomm faced headwinds over the most recent 3-year period, but the longer-term trend shows the business has been able to grow despite a maturing smartphone market. The 5-year view suggests exposure to growth drivers beyond pure handset volumes, such as automotive connectivity, Internet of Things applications, and 5G infrastructure deployment. Book value growth, which tracks the growth in shareholder equity over 3 years, is 7.1%. That's reasonable and suggests retained earnings are being deployed to grow shareholder value. The dividend yield is 2.61%, providing shareholders with a modest income component to offset the near-term growth constraints. In our view, the growth picture presents a mixed setup. Near-term, the company is navigating a cyclical smartphone slowdown and competitive challenges from Apple's in-house chip development and Intel's re-entry into mobile. The 3-year revenue growth of essentially 0% reflects these headwinds. However, the 5-year compound annual growth rate of 11% suggests management has found ways to grow through cycles by diversifying into automotive, EOT, and infrastructure. The challenge for investors is that near-term momentum looks weak, and the market is pricing growth at depressed levels. The bear case rests on the idea that smartphone market share pressure and declining upgrade cycles will persist, capping revenue expansion. The bull case argues that exposure to emerging markets, automotive electrification, and 5G infrastructure deployment will re-accelerate the top line. The data, as of the creation of this video, leans toward the cyclical slowdown view, but history suggests Qualcomm has found ways to adapt. Now let's talk smart money. What institutional capital is actually doing with this name? 21 top-tier super investors and fund managers currently hold Qualcomm in their portfolios. Let's look at the largest positions and what they're doing with them. David Katz of Matrix Asset Advisors holds Qualcomm as 3.39% of his portfolio and has been a net buyer, adding 32.03% to his position recently. Harry Byrne of Soundshore holds the stock at 3.21% of his portfolio and has been a modest net buyer, adding 3.61%. David Tepper of Appaloosa Management holds Qualcomm at 2.86% of his portfolio, but has been a net seller, reducing his position by 8.03%. Mayors and Power Funds holds the stock at 0.91% of their portfolio and has been reducing the position by 15.85%. The overall picture from Guru holders is mixed. Some of the most prominent names are still buyers, but we're seeing selective profit taking from high-conviction positions. Looking at the broader institutional investor base, 15.8% of 13F institutional filers, that's mutual funds, hedge funds, and endowments that file holdings with the SEC, are net buyers of Qualcomm. For context, a reading above 50% would indicate the broad institutional base is bullish. At 15.8%, institutional investors as a group are largely neutral to slightly defensive. Insider ownership is vanishingly low at 0.18%. Meaning company executives and board members own almost no stock. That's a red flag from a governance perspective. When insiders own little to no stock, alignment between management and shareholders can be questioned. Over the last 3 months, We've seen 0 insider buys against 6 insider sells. That's a warning signal. Executive selling, while the stock is near year-to-date highs and sentiment is bullish, often precedes periods of underperformance. In our view, the smart money picture warrants caution. While some super investors like David Katz are still accumulating, the broader trend suggests selective profit-taking. The very low insider ownership and recent insider selling suggests that management may be skeptical of current valuation levels or near-term prospects. When smart money is selling and insiders are exiting, contrarian investors should take notice. And finally, the verdict. Let's bring it all together. On valuation, Qualcomm trades at a moderate premium multiple with a meaningful margin of safety to intrinsic value estimates, but growth expectations have been marked down significantly, raising the question of whether current earnings multiples are justified. Financial strength is solid, no distress signals, credit metrics are healthy, and the balance sheet can support operations and capital returns. Profitability is one of the company's core strengths. 55% gross margins, 27% operating margins, and 28% free cash flow margins demonstrate a business model with durable unit economics and pricing power. Growth, however, is the constraint. 3-year revenue growth is essentially flat, and while 5-year growth is decent at 11%, the near-term setup looks cyclically weak with smartphone saturation and competitive pressures creating headwinds. Smart money is showing caution. Super investor David Katz is still a buyer, but institutional interest is lukewarm. Insiders are selling, and insider ownership is minimal. Bringing it together, in our view, Qualcomm presents as a profitable, cash-generative business in a mature, cyclical industry facing near-term demand constraints and competitive pressure. The margin of safety to intrinsic value is appealing, but it reflects depressed growth assumptions that may or may not be justified. The upcoming earnings report on April 29th will be critical in determining whether near-term momentum can improve. This is a stock that warrants close attention to the earnings results and management guidance. Not a clear buy, not a clear sell, but a company worthy of active management and tactical positioning. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Qualcomm Inc. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.